Welcome, everyone. As a professor and someone who sits on the board of CA examiners, I've seen so many students get tangled up in what is, without a doubt, one of the most critical topics you'll ever face, corporate valuation. So today, we're going to untangle it together.
This is the big question, isn't it? How much is a company really worth? We're going to move way beyond just plugging numbers into formulas. We're going to get a feel for the practical application, the stuff you'll need not just to pass your exams, but for your entire career. Okay, let's dive in.
All right, here's our game plan. We'll kick things off with the why. Then we'll look at the core methods, take a deep dive into the most important one, and finally, talk about how you blend the technical stuff with your own professional judgment. It's a step-by-step approach, just how you should tackle it in the exam.
Okay, so before we even think about touching a calculator, we have to understand the why. Why do we even do this? Believe me, valuation isn't some newfangled idea. It has a super rich history and some incredibly important modern uses.
You see, this whole quest to figure out a company's true worth, it's been driving global business for centuries, and now it's at the very heart of what we do as professionals. For you, right now, mastering this is absolutely non-negotiable for that final paper.
And look, the reasons we put a price tag on a company are all over the map. Sometimes it's for internal strategy, to find out what really drives value. Other times, it's for the big stuff, mergers and acquisitions. And you know for a fact that's a hot topic in your exams.
All right, so we've got the why down. Now for the fun part, the how. There are three main ways to do this, and I want you to think of them as three different lenses you can use to look at the exact same company. The ICA definitely expects you to be comfortable with all three.
This slide just nails it. It breaks down the three pillars so simply. The asset approach is about what you have. The income approach is about what you earn. And the cash flow approach? That's about the cash you will generate. And notice the timeline. We're moving from looking in the rearview mirror to looking through the windshield. That's a key shift.
So, what's the catch with just looking at assets? Well, it's simple, sure, but it has one giant flaw. It's totally backward looking. It tells you zero about a company's future potential. And in business, the future is everything. That's why we need something more dynamic.
And that brings us to the big one. The method that's most widely used, and you better believe the most heavily tested. I'm talking about discounted cash flow, or DCF. If you're going to master one thing from this chapter for your exams, this is it. So let's really dig in.
Now I know DCF can look a little intimidating at first, but if you break it down into these 5 steps, it's totally manageable. The logic is actually quite beautiful. A company's value today is simply all the cash it's going to make in the future, just brought back to today's value. And how do we bring it back? We use a discount rate, usually the WACC, which is just a blend of what it costs the company to use both debt and equity. Let's talk about free cash flow. This is so important because, well, cash is real. It's not profit, which as we know can be massaged with different accounting rules. This is the actual cold, hard cash left over after you've run the business. It's the lifeblood of the company, ready to be given back to investors.
Okay, I need you to lean in for this one, because this is where so many students lose marks. The terminal value. In most models, this single number can be more than half of the company's entire value. That means your assumption for the long-term growth rate is incredibly sensitive. Change it by just a tiny bit, and your final answer swings wildly. It is a classic exam trap. Don't fall for it.
So DCF gives us this beautiful, theoretical, intrinsic value. But here's the thing. We can't just live in our spreadsheets, right? We need a reality check. We need to look outside and ask, what does the market think? And that's exactly where relative valuation comes into play. This method is much more direct. Instead of building this complex model from scratch, we just look around. We ask a really simple but powerful question. What are other similar companies selling for in the market right now? It's basically valuation by comparison.
And the king of all these comparison metrics, or multiples, is probably the PE ratio. You hear it on the news all the time. But what is it, really? Just think of it like this. It tells you how many rupees investors are willing to fork over today for just 1 rupee of a company's earnings. Simple as that.
This table makes the concept crystal clear. Look at this. The rest of the industry is trading at 20 times their earnings, but our company X is only trading at 15 times. So what's the story here? Well, it might suggest that our company is undervalued compared to its friends. See how powerful that is? It gives us a market-based story to tell alongside our technical DCF analysis.
Okay, so now we have two numbers. We've got our intrinsic value from DCF, and we've got our relative value from the market. And guess what? They will almost never, ever be the same. So, what do? This is where the science of calculation stops and the art of judgment begins.
And this isn't just some abstract idea. This quote comes directly from the ICAI's own material on the Vodafone Idea merger. It's a perfect real-world example. They did a technically correct valuation, but the market hated it. Why? Because of something we call perceived value. It's about market sentiment, emotions, things you just can't plug into a spreadsheet.
So at the end of the day, what are we really doing? We're not finding one single magic number. What we're doing is creating a valuation range. We're figuring out the lowest price a seller would take and the highest price a buyer would pay. The final deal always happens somewhere in that negotiated space in the middle.
All right, let's bring all of this home. Let's put it into a clear framework you can use to score marks in the exam hall and, just as importantly, to succeed in your career.
These are the big takeaways. Please burn these into your brain. Look, anybody can learn to plug numbers into a formula. What's going to make you a truly great chartered accountant is your ability to step back, to think critically, to justify your assumptions, and to understand the story behind the numbers. That's the real skill.
So, I'm going to leave you with one final question to chew on. If every single method gives you a different answer, what does fair value actually mean? Really think about that, because pondering that question will teach you more than any formula ever could. That's the kind of critical thinking we, as examiners, are truly looking for. All the very best with your studies.